Hey, welcome back. Let me tell you something that most trading courses never tell you. The traders who make consistent money over years are not the ones with the best strategies. They are not the ones who find the best coins. They are not the ones who predict the market perfectly. They are the ones who survive long enough to get good. And survival in trading comes down to one thing and one thing only: risk management. You can have the most accurate trading strategy in the world, but without proper risk management, one bad trade, one emotional decision, one unexpected market move can wipe out weeks or even months of profits in a single session. I have seen it happen to beginners. I have seen it happen to experienced traders. It does not matter how good you are. Without a risk management system protecting your capital, you are always one bad day away from losing everything you built. Today, we are fixing that permanently. This is your complete risk management masterclass. By the end of this video, you will have a full system that protects your capital, controls your losses, keeps your emotions in check, and gives you the foundation to trade consistently for years without blowing up your account. Let us get into it. Never risk more than 2% per trade. The first and most important rule in all of risk management. Never risk more than 2% of your total trading capital on any single trade. This is called the 2% rule, and it is the foundation that every professional risk management system is built on. Let me show you what this means in real numbers. You have $1,000 in your trading account. 2% of $1,000 is $20. That means the absolute maximum you should be willing to lose on any single trade is $20. Not $100, not $200, $20. You have $5,000. 2% is $100 per trade maximum. You have $10,000. 2% is $200 per trade maximum. Now, here is why this rule is so powerful. Imagine you have a terrible stretch of trading, 10 losing trades in a row. That is a genuinely awful run that almost no strategy produces. But with the 2% rule, after 10 consecutive losses, you have lost approximately 18% of your account. You still have over $800 of your original 1,000. You are still in the game. You can still recover. Now imagine you ignored this rule and risked 20% per trade because you were confident in a setup. Three losing trades in a row, and you have lost 60% of your account. To get back to where you started, you now need to make 150% returns. Most traders never recover from that. Small losses are a cost of doing business. Large losses are a threat to your survival. 2% maximum. Every single trade. No exceptions ever. Always set a stop loss before you enter. Rule number 2. Every trade needs a stop loss placed before you click the buy button. A stop loss is a predetermined exit point. It is the price level at which your trade automatically closes if the market moves against you. It removes the most dangerous element from trading entirely. It removes your emotions from the exit decision. Here is what happens when traders do not use stop losses. They enter a trade. The price starts dropping. They tell themselves it will come back. It drops more. Now they are down 15% on the trade and the loss feels too big to accept. So they hold and hope. Sometimes it does recover. And that lucky recovery reinforces the terrible habit of holding losers without a stop. But sometimes it does not recover. Sometimes that 15% loss becomes 30%, then 50%. And by the time they finally exit, a trade that could have cost them $20 has cost them $500. A stop loss prevents this entirely by making the decision before your emotions are involved. Here is how to place a stop loss correctly. Your stop loss goes at the level where your trade idea is clearly wrong. For a long trade based on a bullish order block, the stop goes below the full order block zone. If price closes below that zone, The institutional orders you were trading with are gone, and the setup has failed. For a trade based on a key support level, the stop goes below the full support zone, not just below the recent candle, below the complete zone. One critical rule that you must remember forever: never move your stop loss in the direction of the loss. You can trail your stop in the direction of profit to protect gains, but you never widen it to avoid taking a loss. Moving a stop to avoid a loss turns a small, manageable loss into a potentially catastrophic one. Set it before you enter, place it at the right level, honor it every time. Always calculate risk to reward before entering. Rule number 3. Before you enter any trade, you must know your risk to reward ratio. Risk to reward simply means how much you stand to lose compared to how much you stand to gain. If you are risking $50 on a trade and targeting $100 of profit, your risk to reward ratio is 1 to 2. For every $1 you risk, you are aiming to make 2. The minimum ratio most professional traders accept is 1 to 2. The best setups offer 1 to 3 or better. Here is why this number changes everything about your trading results. Imagine you take 10 trades, you win 5 and lose 5. That is a 50% win rate, which sounds average. But if every win makes $2 and every loss costs $1, here is your result. 5 wins times $2 equals $10 gained. 5 losses times $1 equals $5 lost. Net result is $5 profit with a 50% win rate. Now imagine you flip this and your wins only make $1, but your losses cost $2. Same 50% win rate. 5 wins times $1 equals $5. 5 losses times $2 equals $10. Net result is $5 lost. Same win rate. Completely opposite financial outcomes. The only difference is the risk to reward ratio. This is why professional traders can be wrong more than they are right and still make money consistently. Their winners are always bigger than their losers. Before every single trade, calculate your risk to reward. Know where your stop is, know where your target is. Make sure the math makes sense before you commit any capital. If the ratio is less than 1 to 2, skip the trade. Better opportunities will always come. Control your position size on every trade. Rule number 4. Position sizing is the practical tool that makes all of the other rules work together. Position sizing means calculating exactly how many units of an asset to buy or sell on each trade based on your stop distance and your risk amount. Here is why this matters. You have decided to risk 2% of your $1,000 account on a trade. That is $20 maximum risk. Your entry is at $40,000 for Bitcoin. Your stop loss is $500 below your entry at $39,500. If you bought one full Bitcoin, a $500 move against you would lose you $500. That is 50% of your account, way more than your 2% rule allows. So you adjust your position size to make the math work. You are risking $20. Your stop is $500 away. So you divide 20 by 500. The answer is 0.04. That means you should buy 0.04 Bitcoin on this trade. If your stop is hit, you lose exactly $20. Your 2% rule is respected. This calculation applies to every asset, every trade. The formula is always the same. Maximum risk amount divided by stop distance in dollar terms equals your correct position size. Learning this formula and applying it consistently ensures that no single trade can do serious damage to your account, regardless of how far the market moves against you. Protect your mindset as fiercely as your capital. Rule number 5. Your mindset is part of your risk management system. Most traders think risk management is only about numbers, stop losses, and position sizes and percentages. And those things are critical. But the psychological side of risk management is equally important because even with perfect rules in place, emotions can cause you to break every one of them. Here are the three psychological risk management rules that protect your trading account. Psychological rule 1. Set a daily loss limit and honor it completely. Decide before the trading day begins that if you lose a certain percentage of your account, for most traders 3 to 5%, you stop trading for the rest of that day. No exceptions. Why? Because after consecutive losses, your emotional state is compromised. You are frustrated or anxious or desperate. Every trade you take in that emotional state has a lower probability of success than your normal baseline. Stopping protects you from making your bad day catastrophically worse. Psychological rule 2. Never increase position size to recover a loss. After a losing trade, the temptation is to take a bigger position on the next trade to make the money back quickly. This is called revenge trading, and it almost always makes things worse. Your next trade should be exactly the same size as your previous one, never larger because of a loss. Psychological rule 3. Take breaks after both winning and losing streaks. After a series of wins, overconfidence can cause you to take larger positions or lower quality setups. After a series of losses, desperation can cause the same. Stepping away from the charts and resetting mentally after significant streaks in either direction protects your judgment. Your mental state is a risk factor. Manage it like one. Let me bring this entire masterclass together into your complete risk management system. Rule 1. Never risk more than 2% of your account on any single trade. Small losses keep you in the game. Large losses end careers. Rule 2. Always set a stop loss before entering. Decide your exit before your emotions are involved. Honor the stop every single time without exception. Rule 3. Calculate your risk to reward before every trade. Minimum 1 to 2. Aim for 1 to 3. Never take a trade where you risk more than you stand to gain. Rule 4. Use position sizing to control your actual dollar risk on every trade. The formula is maximum risk divided by stop distance equals your correct position size. Rule 5. Protect your mindset. Set a daily loss limit. Never revenge trade. Take breaks after significant winning and losing streaks. Here is the truth that most traders learn the hard way. Making money in trading is not the hard part. Keeping it is. Any trader can have a good week. Any trader can have a lucky streak. But the traders who are still here 5 years from now, still trading, still growing their accounts, still learning and improving, those are the traders who built a risk management system and followed it consistently, even when it was uncomfortable. The market will always test your discipline. It will always create situations where breaking your rules seems justified. A trade that looks too good to risk only 2% on. A loss that feels like it definitely needs to be recovered immediately. A winning streak that makes you feel invincible. In every one of those moments, your risk management system is what stands between you and a decision you will regret. Build the system. Trust the system. Follow the system. If this masterclass gave you a complete framework for protecting your capital, please hit the like button and subscribe. Share this with one trader you know who is struggling with losses. This video could genuinely change their results. Drop a comment below and tell me which of these 5 rules you struggle with the most. I read every single comment and I will give you specific advice for your situation. I will see you in the next one.